Welcome to Chapter 15, Special Forms of Contracts. This chapter is going to be broken into a couple different videos, so just bear with me. They'll be about 15 minutes apiece. All right, so negotiable instruments. There are four kinds that we're going to talk about today: drafts, checks, promissory notes, and certificates of deposit. These are also called commercial paper. And perhaps you have seen checks before, so this is nothing new to you. But if you're younger, you may have actually never drafted a check. You may use your debit card more frequently. And maybe your parents or your grandparents are actually writing the checks. Yes, I, on occasion, write a check. So it is a negotiable instrument, and that's what we're going to be talking about. So before we get into each kind, I want to talk to you a little bit about the Uniform Commercial Code, Article 3. And this is because this is where the standard requirements for these negotiable instruments come from. At any time you want further information about the UCC or the Uniform Commercial Code, you can go right to it on a website, and they list out the different articles. And not all of them have to do with contract law necessarily, but there are special ones that we will be looking at. So for this chapter, Chapter 15, we're going to be looking at Article 3, Negotiable Instruments. And you can see we have all these rules as it relates to them. The different obligations, who can accept it? If there's negligence, what do we do? What if there's a stolen cashier's check or a certified check? How is that handled? And the website, or even the book for the UCC, describes all of these elements. So the first one we're going to talk about are drafts. Drafts are three-party instruments. And don't let that freak you out. All it really is that you are asking the bank to provide funds to someone else. All right, so there's three parties: the bank, the person that is asking for the money, and then the person or entity where the money is being delivered. There are three different kinds. We have time drafts, which are payable in the future; a slight or demand draft, meaning payable upon presentation. So if you go into the bank and you present it, like a cashier's check, you would expect to get that money back. And then we also have trade acceptances. So there might be a draft extended with the sale of goods, like a car. Checks. Checks, again, are a negotiable instrument. They are three-party, just like drafts. So we have Jeffrey Atwood here. And we'll say it's Huntington Bank, and to pay to the order of Elizabeth Burton in the amount of $1,500. So when Elizabeth gets this check, she should be able to go to her bank and get it cashed or deposited, just like money. And these are payable upon demand. So even though, you might try forwarding a date sometimes, that doesn't always work. So post-dating a check isn't always a good thing to do, especially anymore. It's so quick to take a picture of a check if you're with Huntington Bank or some other bank and it doesn't deposit, that they may not, check out the date on there. So these are ones that are payable on demand. A promissory note is a promise to pay in the future or on demand. It can be in single payments or multiple payments. So for instance, you buy a car and you don't have all the money up front to buy the car. So you get a loan through Bank Zone Inc. Bank Zone Inc. is like, sure, we'll give you $10,000 to buy that car because that car is your collateral. Now, they don't do it generally for free, right? They're not being a bunch of nice guys. So they want some interest out of the deal. If they're going to give you money, they want their 8% interest, which is located here. Oops, sorry about that. And that this note shall mature and be payable along with the interest June 30th, we'll say 2028. And so maybe it's a 10-year loan, maybe it's a 5-year loan. And this is, again, just a promise to pay. It could be for a car note, it could be a finance computer, or even a cell phone through Verizon, right? You may have clicked on something that said, you promised to pay the $24 a month for your new iPhone for the next 2 or 3 years, however long that is. And sometimes lenders require security or collateral. And it can be in the form of a guarantee. So maybe you can't afford to get this loan on your own, so you have a parent co-sign. It could also just be the car itself. So if you default on your payments, the bank can possess the car as collateral. And then lastly, certificates of deposit. So this is created with a financial institution, such as a bank or a credit union. And now the financial institution is agreeing to pay back deposited sum plus an interest in a set time. So what does this mean? Well, if you want to use a certificate of deposit to maybe save some money, in 3 years from now, you've decided that you want to buy a house. And so you have this $10,000 that you are ready to put down, but you're not ready to buy a house. You can go to the bank, get a CD or certificate of deposit that $10,000, and then over the next 3 years, it will gain interest, which is payable to you at the time that the CD is up. So the CD is actually a set time, and you can set it for 3 years or 5 years, and there may be a penalty if you try to take back the money before the time is up. So just check on that. And now we're going to talk a little bit about agency contracts. So again, I just want you to have an overview of an agency contract, and it sounds more complicated than it is, I promise. Okay, so now let's think about you buying a house. This is you. You are what they call the principal. And this is the real estate agent. Between you and the real estate agent, there's going to be an agency contract. And in that contract, it is going to spell out the various terms. What is the agent going to do for you? Is the agent going to have open houses? Are they going to provide marketing and advertising for your home? How are they going to deal with a buyer? All of those terms and conditions will be spelled out in this agency contract. The third party in this instance would be a buyer. So now your house is ready to sell. The agent has a buyer for the house, and now the agent on your behalf is going to deal with the buyer. So it takes out this back and forth between the principal and the third party, or in this case, the seller and the buyer. The agent is handling all the paperwork for the seller. Now, ultimately, the principal and the third party have an obligation to each other. And at the end of these videos, I do have a scenario or a quiz question that kind of walks through what that actually looks like. But for now, hopefully you've just gotten a basic understanding of what it means to have an agency contract. One type of agency contract outside of perhaps a realtor is in relation to independent contractors. So somebody who's not an employee, but a company wants to still hire to do something for a certain amount of time. So for instance, if I work for a cabinet company and we sell cabinets, but we don't install them, we might want to hire independent contractors to install the cabinets. They're not employees. They get paid on a different structure, and it's for the piecework, right? We don't pay insurance or overtime or any of those employee type benefits. So here's a scenario. Mary has been hired by a company to write courses for a web-based training organization. Mary works at the offices of the organization. Mary is given content guidelines and a contract for each course that she writes. And she is paid a flat fee upon the completion of the course. It can take anywhere from 2 weeks to 6 weeks to complete a course. The organization wants the contractors to work in their offices during the regular 40-hour work week, unless they need to be elsewhere to do research. The organization provides a computer to Mary. Mary also is able to use other employees at the organization for word processing and editing. So my question to you is Mary an employee or an independent contractor? And for the answer to that, you're going to need to go to video number 2.